Hello, investors and traders, and welcome to the weekly market report. I'm AJMonte, Chief Market Strategist with Sticky Trades, and we are seconds away from the markets closing right now on this Friday, November 17th. Let's get right to the charts. There we go. We are officially closed, and as you can see here from this daily candle chart of DIA, we have a little red candle right there, lower high, but we have a higher low that's known as a half signal. We have that after a long stretch of green. We now have a red candle after that stale green light. Looking straight down, you could see that we have a cross in the stochastic oscillator, and we're about to cross with a sell signal on the CCI. Now, with that said, we also have a wide divergence here from the 20-period moving average. That's known as the rubber band effect. Now, if you're following along with my 7-point trading checklist, and I'll get to that in a moment, you'll see that the drop in volume on the way up is bearish, and that wide divergence is known as the rubber band effect. Now, this is all happening at a key resistance area right up here. So I could delete this line. I like to keep my charts clear and clean. And you can see that we have gaps below the market here, which will eventually act as price magnets. So that is DIA. I am not changing that target. I know it's further away than where we were last week, but that downside target is still in place at 335.77. Now let's get to IWM. By the way, all the price targets below the market are still in place. IWM was the only one that I went upside with last week. That was a two-part forecast right there, and this gap up was driven by a knee-jerk reaction to the CPI. I'll get to that as well as we talk about the geopolitical and economic condition. So that downside target, again, is still at 364.98. Keep your eye on those support levels. As we come into next week, we have the 20-year bond auction. We have no idea how that's going to go, but if it was anything like what we saw last time, it could very well shock the markets right back down. So again, that's IWM. If we look at QQQ, this is the NASDAQ ETF. You can see that we continue to battle this number 5 fan line. We are officially starting to pivot lower. We had the official pivot yesterday. We have the continued drop in volume on the way up. That is taken as a weakness on the buy side. So that's marked as a bearish signal on your 7-point trading checklist. And we have a cross here on the stochastic, and we're about to cross with a sell signal on the CCI. Now keep in mind that while we are showing higher price highs, the CCI is showing lower highs. That is a negative divergence that can be taken all the way back here. That's one of the most powerful flags that I bring up each and every time we're looking at the charts. And when they show up, they are definitely not to be ignored. So I know, again, that's a far stretch to the downside, but my downside target is still intact at 361.19. Now let's go to SPY. This is the S&P 500 ETF. Again, we have negative divergences here after higher price highs, still continued lower highs on the CCI. Look what happened last time, right before the rally a couple of weeks ago when I forecasted that we would rally. We had a positive divergence. You see that? This week and over the past couple of weeks, we've had the opposite occur with that negative divergence. Now, I will be talking more about these gaps right here when we get towards the end. So hang in there right to the end, and you'll get a good lesson on what these gaps mean for traders especially. So that downside target is 427.50. Now let's look at the VIX. VIX continues to move lower, but it's getting a little tired. Again, we have a positive divergence here on the VIX. Remember, it's the opposite of what we just talked about. We have lower price lows, but we have higher lows, not just in the CCI, but also higher lows in the stochastic. We also have a very, very small 1 penny gap right there up at the top that I've given a guarantee will eventually fill. I did mention that you just don't know when, but all gaps on the VIX fill because it's an oscillating index. It's not a stock. Now, I want to talk about silver before we get into the economic news. Now, SLV is one that I trade. I make that very public. Please follow me on my Twitter page. and you'll get my alerts when I put those out. I bought back all of my silver back here at $20.16. I made that announcement on Twitter. And then yesterday I sold 5% more right up here at 21.94. Now, again, I tried my best to put the announcement out before I make the trade. I did that yesterday, but I didn't spend a whole lot of time waiting for everyone to trade ahead of me. I put it out and I immediately went to my brokerage account and started putting in my sell order. And I got filled. I was messing around with the limit price of 22. And when I saw it start to drop and form this longer shadow on top as a shooting star, I decided to move that limit price down until I did get filled. So again, ahead of time, as the price starts moving back towards this moving average or even moving towards filling this gap, I will be buying that silver back and parlaying the position, because that's what we do. We buy more on the way down with the cash that we've created from the sale above the market. Now, some of you may be paying attention as to what's happening in the trucking industry. And if you know anyone who's in the trucking industry, an independent trucker or otherwise, they will tell you that the loads are pretty light. And as a result of that, companies tend to lower prices in competition with one another to be able to get the cargo they need to keep the trailers running. And while there's a price battle going on there, it also puts these companies at risk, because obviously their profit margins shrink, and we saw what happened to Yellow Trucking. That is a domino effect that I believe is going to continue down the road. Now, this is an area that I do have experience in. Years ago when I was on Wall Street, I bankrolled a company called Redline Trucking. My brother-in-law operated it, I funded it, I bought the trucks. So I know a lot about trucking, and this is what makes our economy go round. The trucks are the blood that goes through the veins of our economy, which are the highways. And this is a leading indicator. It's not a lagging indicator. Now, one of the things you cannot disguise is our debt and the cost of servicing our debt. Now, this is an older chart. You have to understand that the cost of servicing our debt has now moved over the $1 trillion mark. So we are now up here. That's, again, you cannot disguise that. That's public knowledge. It's reported. The other thing that you cannot hide are interest rates. And this coming week, we are about to watch the 20-year bond auction, and that will give us a leading indicator as to what's happening with interest rates. So stay tuned for that. Another thing that we cannot ignore, nor should we ignore it, is the cost to U.S. taxpayers as our government continues to spend. There is no end in sight to this spending frenzy that we are witnessing. And one of the things that you have to understand, and I reported this many months ago with regard to the World Economic Forum, they are pushing hard for the Green New Deal, everything going carbon neutral. And if that continues to move throughout the U.S., it's going to cost taxpayers a bundle just trying to go green. Right, so we're going to have to pay for all this spending when the U.S. Treasury issues bonds. I'll get to that in a little bit. But when the bonds are issued, the government has to find a way to get those bonds sold, whether it be institutions, banks, money managers, it could be other countries. If the bonds don't get sold, they have to lower the price of the bonds to make them more attractive. Just like anything else, when you have overhead supply, you have to lower the price to make it attractive to the buyers. And interest rates are inversely related to that. As the bond prices drop, interest rates go up. Now, this is very important that you pay very close attention here. Whether you've traded a bond in your life or not, I would encourage all of you to start learning more about the bond market, because as we continue to move into this black hole of an economy, you have to understand that the U.S. Treasury has to sell bonds to raise money, to pay for the spending, to pay for the cost of carrying this debt. And if we don't have that, the economy comes crashing down. So you can see that China, which is the second largest debt holder right behind Japan, if they are pulling back on the U.S. Treasury holdings, then that means there is less demand for our bonds, which means bonds have to drop, interest rates go higher, and then as a result, the stock market comes down with the bond market. So they're directly related. Now, some of you are looking at jobless claims and the CPI numbers and the GDP. These are the numbers that are most easily manipulated. Like I said, these numbers with regard to the bond market and the debt and the cost to carry the debt and holding that debt is very public. You cannot manipulate that, but these are easily manipulated. But even with the manipulation, you could see that continued jobless claims are reaching 2-year highs. Unemployment is on the rise. Inflation might be under control, but don't let that fool you, because if we go into a recession, which I believe is going to be a very severe recession, people just don't have the money to buy things. And like the bond market, if producers can't sell their products, what do? They lower their prices to get the inventory out of their warehouses. And so don't let that fool you into thinking that the Fed is doing this great job with higher interest rates. The interest rates can continue to go higher while prices drop, but that would not be a result of the Fed controlling inflation. It would just be a simple supply and demand equation that would be affecting those prices. Now, I found this to be extremely interesting, and that this came out yesterday. 52% of U.S. buyers are skipping, right? Outright skipping Black Friday 2023. And why is that? Because they just don't have the money to spend. This is something you could easily look up. Just go right there to YouGov. They have that report right there so you could read it in its entirety. And I would, again, do your homework, because I don't expect anyone just to take my word on these reports. I would love it if you go out there and do your own homework and dig around to find the facts. Now, another thing that came out this week is Walmart CEO made an announcement, and he expects to see a period of deflation. This is exactly what I just mentioned. A recession is nothing more than a consumer strike, right? They don't have the money to spend, they're not going to spend it. And as prices come lower, they still may not go out and spend what they don't have. Credit cards are on the rise as far as the revolving debt crisis that we're faced with as a nation. And Walmart came out and made that warning, and look what happened to the price of stock. It just plummeted upon those words leaving his lips. Now, this is what I want to get to with regard to gaps. There are different types of gaps that you see in the market. There are intraday gaps, there are daily gaps, weekly gaps. But this is a series of gaps that you do not see all that often. You have gap over gap over gap. And what is that called? This is a breakaway gap, a runaway gap, an exhaustion gap. Now, we are seeing this right now in the S&P. So what I did is I took an example of this right here on this chart. There you go again. Here's the breakaway gap, here's the runaway gap, and here's the exhaustion gap. And so what I decided to do is I decided to take that chart, that textbook chart actually, and overlay it on top of what we're seeing here in the S&P. Let me just move that on over so you could see that. So this is how it correlates. You have the breakaway gap right here. You have the runaway gap right here. And you have, guess what? That's the exhaustion gap. Why do they call it an exhaustion gap? Because the market is starting to get exhausted after all that upside activity. Remember, back here, the CPI triggered this rally and it continued. And so now you could see right on the charts that I showed you earlier that the charts are showing lower volume, and that's giving us a sign that the buyers are weakening. Now, here's my other guarantee, and I got to be careful because I have a couple of guarantees out there, one of which is the guarantee that the VIX gap above the market will fill. Well, here's my guarantee. This exhaustion gap that we're seeing in the S&P will fill. That's my guarantee. Again, I can't tell you when, but I think this one will be soon. In fact, the VIX gap may fill before this exhaustion gap fills. But one of the reasons I'm making that guarantee is because never in history have we had a liquid stock or a company that's traded on the NASDAQ or the S&P that has significant volume. Never has an exhaustion gap been left unfilled. They all fill. Now, I can't give that same guarantee for the breakaway gap or the runaway gap, but I can for the exhaustion gap. For you option traders out there, make sure you keep an eye on that, because this is a perfect time to be legging into some spreads if you don't have some spreads on already. Now, again, I want to thank you so much. If you want a copy of my 7-point trading checklist, I mentioned this last week and I'll mention it again. We have a free membership that we offer on stickytrades.com right now. It will allow you access to my 7-point trading checklist. It will give you access to my free video regarding the 1% rule for managing risk. And you will have links to these reports, the midweek report and the weekly market report, so you have easy access to those videos instead of having to hop over to YouTube. So again, thank you so much. Have a great weekend, and we'll talk to you next week. So long.